Another specific area addressed by the standard relates to onerous contracts. Onerous contract is a contract in which the unavoidable costs of meeting the obligations under the contract exceed the economic benefits expected to be received under it. In other words, it is a loss contract that cannot be avoided. The difference from future operating losses is that there is a past event entering into contract that cannot be avoided. On the other hand, many contracts can be cancelled without any compensation, so there is no obligation and contract would not be onerous as the cost of fulfilling the contract can be avoided. Therefore, if a company identifies certain contract as onerous, provision must be made in amount of unavoidable cost of fulfilling it. Now, unavoidable costs can be either net cost of fulfilling the contract, which means costs less some income from the contract, or penalty from non-fulfilling the contract, whichever is lower. Of course, the entity would choose the less expensive option to exit onerous contract. Similarly, as in future operating losses situation, an entity must look for any impairment of assets dedicated to contract in accordance with IAS 36 and recognize it first. Now let's see an example. Except for aquaparks, swimmers operate also 2 theme hotels in Aqualandia. Hotels are held under non-cancelable operating lease that expires in 3 years. Swimmers' managers estimate that due to overall decrease in number of visitors, hotels will make annual loss of €1 million each year if continuing operations. Swimmers may also prematurely terminate the lease, but with penalty of €2 million. What should Swimmers' company do in its financial statements in relation to this situation? First, let's assess 3 conditions for provisions. Is there any present obligation as a result of past event? Yes, there is, as the lease contract is non-cancelable. It is a clear legal obligation. Is outflow of economic benefits probable? Yes, it is. Swimmers will have to pay lease payments or penalty. Is there a reliable estimate? Yes, there is. Once again, let's not mix onerous contract with future operating losses. This is not future operating loss situation because there was a past event entering into the lease contract that became onerous after some time. And this cannot be avoided in the future, only under some expenses that must be covered by provision. Now let's calculate the amount of provision. Penalty to exit the contract is €2 million, and loss in case of completing the contract, or net cost of fulfilling, is €1 million times 3 years. Therefore, provision would be measured at lower amount, that is €2 million. Provision should be recognized to profit or loss as an expense for penalty on onerous contract. Just a small remark here. As a penalty would probably be paid within the next 12 months, depending on the time of cancellation, this liability or provision would be shown under current liabilities.